Hey everyone, it's Chris Hobart here, your Wealthologist, back with another episode of the Weekly Wealthologist. And today, we're diving into the Federal Reserve's latest decision and what it means for you. Now, spoiler alert, they're not cutting interest rates anytime soon. Now, that might sound like bad news, maybe if you're hoping for lower borrowing costs, but it could actually be good news when we're talking about fighting inflation. And also good news for savers and seniors and folks that maybe like to have stuff in savings accounts. Now, tariffs are also back in the spotlight and not necessarily in a good way. So we're going to talk about what's happening and how it might affect your wallet. All right, you ready? Let's get to it. As the Fed, they're going to hold the line, saying no rate cuts yet. They've made it real clear they're not touching interest rates right now. Now, why? Well, inflation, that nasty I word, is being really stubborn. So I want to break this down for you. The Fed's goal is to get inflation down to 2%. But in 2024, their favorite measure of inflation, what's called the PCE price index, it only dropped to 2.6%, which is barely better than the 2.7% at the end of 2023. Now, if we look at what's called core inflation, which excludes food and energy, it's at 2.8%, which is still too high, obviously. Then there's what we call super core inflation. Now, this one strips out not only food and energy, but also goods and housing rents. Basically, what does it measure? But guess what? Instead of improving, it actually got worse in 2024. It rose 3.5% compared to 3.4% the year before. Now, it's kind of interesting. You see, the Fed, they used to tell everyone to watch super core inflation. That was the important one. Keep an eye on that one. But I got to tell you, once it stopped showing rapid inflation declines, oddly enough, they kind of stopped talking about it. Funny how that works, right? So let's talk about tariffs real quick and what it really means for inflation. Obviously, we've heard this past week the Trump administration is cranking up tariffs on imports from Canada and Mexico and China. Now, in response, those same countries are hinting at retaliation tariffs of their own. So what happens next? Well, some people, they hear tariffs and they immediately think higher inflation. And yes, tariffs do raise prices for the goods they're placed on. But here's the key that I want you to be thinking about. Inflation isn't just about prices going up, it's about the overall money supply. And if the Fed doesn't loosen monetary policy, which it doesn't look like they will, then yes, some items are going to get more expensive. But people will also have less money to spend on other things, which can offset inflation elsewhere. Now, there's a catch to all of this. The Fed and the media, they love a good headline, and you don't want a good headline to go to waste, right? And tariffs give them a great excuse to keep rates higher for longer. So expect the Fed to point to tariffs as the reason not to cut rates. Even if inflation starts cooling off, it's a good excuse. Now, you're probably wondering, what does that mean for my investments? Well, what should you be watching over the next couple of weeks? First, there's going to be a flood of economic reports, jobs data, retail sales, industrial production, and more. And we're going to talk about that on the Weekly Wealthologist. Now, if we start seeing signs of a slowdown, you'd think the Fed might consider cutting rates, right? But not so fast. You see, the Fed and the markets probably won't react immediately. Because here's the biggest risk that we're facing. If the Fed panics and loosens policy too much, too quickly, we could get stuck with what's called stagflation, which means slow growth and high inflation. Not fun. Now, if they hold rates high and the economy weakens, the stock market could struggle. Again, not fun. So what's the bottom line? Well, here's the thing. The era of easy money, it's over. The Fed is playing a cautious game, and that means that investors need to be strategic. Now, my question for you is, what do you think? Do you think the Fed should start cutting rates sooner, or are they making the right move by holding firm and holding off for a while? Let me know in the comments what your thoughts are. And hey, if you were in control of the Fed, what would you be doing right now? Now, if you want to stay ahead of the game, don't forget to like and subscribe and hit that notification bell so you never miss an episode of the Wealthologist Weekly. Thanks for watching, and I'll see you next time.